Hi, I'm Josh Brown. I'm here live at the compound with my friend Mindy Diamond, who is the president and founder of Diamond Consultants. Mindy is one of the premier recruiters and consultants in the financial advisor space. I'm going to ask her about the biggest trends in wealth management, in hiring, in M&A. Stick around. You're going to learn so much in the next few minutes. Okay, so here's what I want to get into. You've got an outlook for 2020, and I don't want to bury the lead. There's been a ton of consolidation in the industry. There seem to be advisors on the move every day. What's going on in wealth management? What should people, whether they're investors, advisors, firm owners, what should we know?
Well, the wealth management space has really changed a lot. It's been a seismic shift. It's driven by a number of things, a perfect storm, if you will. One is a major change in advisor sentiment, where what advisors value today is very different than what they once did. They once valued tremendous amount of upfront money. Now it's much more about wanting freedom, flexibility, and control. Two, the big firms, the wirehouses, are working hard to try and really tie advisors up, but via their retiring advisor or retire in place programs. And the more they attempt to do so, the more frustrated the advisors are, the more the advisors want out.
Right.
And three, I think clients have become really aware of the term, what it means to be a fiduciary, and they're demanding that of their advisors. So clients want more of that fiduciary status.
It's like a question that financial advisors never really had to answer until the last few years. And now they seem to have to justify everything they're doing through that fiduciary lens.
And it's a great thing. It's great for the advisor, it's great for the clients, and it's great for the industry.
All right, so let me get a little specific with you on some of these things. So if you're still at a wirehouse in 2020, it should be assumed that you've already had ample opportunity to A, bring your team to someone else's RIA, or B, if you're big enough, hang your own shingle. Who are the people that still haven't? Are they just newer advisors and they haven't gotten to scale yet? Or are we still seeing boomer advisors go out on their own? Who are these next wave of breakaways?
So the breakaways, so first of all, where advisors are going have become very fractured. Certainly many toward independence, many also toward this newfangled quasi-independent models like First Republic Wealth or Rockefeller are paying some of the largest deals, and very much where advisors are headed.
Those deals look like brokerage firm deals to me.
Oh, yeah, even bigger in some ways. Those are some of the largest deals in the industry. But when advisors may be intrigued by independence, but don't want to have to go out and build something, that independence feels like a bridge too far, those quasi-independent models work. But it is definitely not just that sort of the left-behinders are the ones that are moving now. There were certainly those where deals were large and years ago may have chosen to make a move, but there are many that truly stayed put because they believed that their firm was the best place to be. But as things have changed, the people that are moving
as much.
For sure. And as things have changed and evolved, advisors want different things. And this wave of movers are moving, some because they want to be independent and they're uber entrepreneurial, some because they want to monetize the business and want something familiar, some because they want something in between. And as the industry landscape has expanded, there's more options. So that's also fabulous for the end client.
Okay, so I come to you, Mindy, and I say, hi, I'm an advisor at Wirehouse ABC, and I've got a team of 7 people, and we've got $500 million under management. This is what I'm thinking. I call Cheryl Penny at Dynasty. I bring him my $500 million. He tucks me into a $3 billion firm. I get all of the support I used to get at the wirehouse, and I'm giving up, part of my fees on a basis point percentage. And I'm okay with that because I need support and I don't want to start my own thing. Or I'm $500 million and Wirehouse ABC is launching this new service where they're letting me be an RIA but in their playground. They're saying, don't really leave us. You can leave the broker-dealer side and you could use our corporate RIA. And I know a lot of the big firms are doing that. Or I say, you know what? I want my own corporate RIA. I don't want to be on a platform. I just want to start this thing, pick all my own vendors, owe nothing to anyone. Of those 3 options, what do you tell me as a $500 million team? or is it even more challenging than that?
Well, it's not that it's more challenging than that. It begins and ends with how you want to live your business life.
It's like a personality thing, right?
A personality, a business mix. Where are you in the life cycle of your business? How much of a next generation team and capacity do you have? How entrepreneurial are you? And it is much more the answer to those questions that drive where you wind up.
Right.
It's also not quite as binary as it used to be. It used to be 20 years ago when I started in the business that a top team like that, even a bigger team, $1 billion, $2 billion, the only option would have been to go from Merrill to Morgan, Morgan to UBS,
Right,
or something of the sort.
there's a million options now.
There's a million options.
Yeah.
But there's not a million legitimate options for the really sophisticated, ultra high net worth focused, multi-generational team. There are a million options, but there aren't a million appropriate
Right,
options.
the high net worth client that really needs financial planning, asset management, alternative asset management, lending, like there aren't a million options for that or to do that well. But there are definitely more than there were.
There are a million options that will do it. The answer is there aren't a million that do it well.
Okay.
And it's got to be a personality fit. And so while it's confusing and overwhelming, and it can become a full-time job to explore it, in a lot of ways it's job security for us, because the more the industry landscape or the waterfall of possibilities has expanded, the more a team like that needs sort of someone to help to objectify, and I don't mean this as a sales pitch in any way, but needs help in objectifying what is the difference between going to Dynasty and either being tucked in to an established firm or building my own, or
right.
building my own from an economic perspective, from a business life perspective, from in terms of operationally, in terms of end of the day, who buys the business, all of that.
So a financial advisor who is not up to speed on the nuances of every one of these platforms, they almost have to call someone like you to say, look, I know there are a million options. I have people giving me their business cards. I have private equity firms calling, offering to set me up. Like, what's the right course? Like, you're doing a lot more than just like recruiting at that point. You're basically doing like business consulting, and it's needed because I don't think most advisors understand all the nuances, and you would need like 1,000 meetings to really be able to get that on your own.
Well, that's 100% correct. The truth of the matter is, it will be a full-time job, more of a full-time job to do the
Because
exploration.
you can't do it
right?
twice. You can't call your
Right.
clients and say,
Right.
I screwed this up 6 months ago, we're moving again.
You can, but you definitely
You don't
shouldn't.
want to.
Right. But let's use the example of a private equity firm calls me. So first of all, if you're sitting at Merrill Lynch and you get a call from UBS and you know you want to go to UBS, you don't necessarily need me. I'd like to say we're good negotiators, we can keep it at arm's length, we can streamline the process, but
Right.
less necessary. But when you think about the waterfall of real possibilities, this very expanded landscape of options for ultra high net worth, very sophisticated teams, not even ultra high net worth, but big teams, there are more options than just Merrill to UBS. And even if you're not the slightest bit entrepreneurial, you'd be foolish not to at least get educated or understand a little bit about what it means so you know what you're turning down. If you use the example of a private equity firm approaches me. That's such a good example because while it sounds sexy and an advisor, a standalone advisor might be, flattered by that. How interesting is that? That's fabulous. There are absolute pros and cons to that. The pro is it'll give you credibility, it'll give you capital, it'll give you scale and bandwidth. It's a buyer. It allows you to take chips off the table.
I'm getting those emails like every day.
Of course you are.
I've never even heard of these firms. How many private equity firms are trying to throw money at RIAs right now?
Right.
Are they all?
No, they're not all, but they know it's an annuitized revenue stream, and everybody wants into the action. Those private equity firms, by the way, are not only approaching RIA firms, but they're also approaching advisors that are sitting within the traditional space. But what's the downside?
Mindy, I always say, look, I don't need any money right now, but let's sit courtside at the Knicks and talk about it. Like, let's go to a Giants game and we'll see, like, if we get along.
Well, but that's the point. No. But that's the point.
I'm like, honestly, delete. I don't even respond.
Of course, and you should.
Yeah.
But so while there are pros, there are many cons. You don't want to give up control. You don't want to sell your upside. If the majority of your growth is ahead of you, not behind you, you'd be crazy to sell your upside. It limits optionality. I mean, there's a lot of negatives, and people, especially in the traditional space, don't understand the universe of possibilities. And so you're 100% right. Our jobs become much more fun, much more complicated, much more nuanced, because it's much more than, hey, let me tell you about some hot opportunity at Merrill Lynch. It's really about
You
helping
agree with
somebody
me, though,
understand.
that this is a better environment for a seller than a buyer? And if you're a buyer, you're paying peak multiples for advisors and for firms and even for recruiting in some respect. And you may just be buying other people's headaches right before a bear market. And a lot of this like talent that you think you're acquiring might come available for less like in 2 years if you just calm down. But I feel like so many people have raised money that they like feel compelled to do deals. None of these deals seem like exciting to me.
Well, so first of all, it is very much a seller's market, meaning the
great if you're-
advisor
yeah, it's great
is
if you're
in the
selling.
driver's seat.
Yeah.
There are plenty of really good deals to be had for a buyer and or a seller. But I think the main thing is both buyer and seller need to be incredibly clear about the why. Not buying just for the sake
Not
of
just a
buying,
number.
but buying because it's accretive, buying because it adds capacity, because it adds talent, because it adds a skill you may not have, because there's a real goal that you're trying to solve for.
Do you think so? You mentioned Rockefeller earlier. There are probably now, I think, 10 RIAs that are going for true national scale and brand awareness. Maybe there are more, but like $10 billion plus RIAs that are actively trying to become like this century's Merrill Lynch. Mm-hmm. And I don't know if they'll succeed or how much room there is for how many, but do you feel like as that process happens, they're starting to look more and more like the Merrills and Morgans that they're replacing? Or will there always be a big distinction regardless of how big they get?
I think there'll always be a big distinction, and there's a big difference between a Rockefeller, whose leadership all comes from Morgan and Merrill.
Right.
So that is one that may look and feel more
You're
like
still
Merrill
in the
at
suits
the
and
end of the
ties.
day.
Like it looks like
Yes,
a wire
but
to me.
it's boutique-y, it's got investment flexibility, it's got access to private investments,
Right.
It's built, the core, the chassis is an RIA chassis, and that's a world of difference.
Right.
I think that while there are many RIAs that are looking to really uber grow, and that's if you're selling against them, the sales pitch against them is they're going to be another mini Merrill Lynch. I don't think that that's the case at all.
Okay.
I don't think that's the case at all. Because when people use the term they're going to become a Merrill Lynch and they say it disparagingly, what they're talking about is the bureaucracy, is the bank ownership, is the clash between
no
bank
one's like
and wealth
no
management.
one's saying that like bragging. That's like
Well,
the
right.
reporters are saying this is starting to look more and more like an 80s
It's a total,
Wall Street brokerage.
It's a total negative.
Right.
It's an absolute insult.
All right, so the last thing I want to get to is what is a thing in the wealth management space that's on your radar for this year that not enough people are talking about or that you find really interesting?
Well, for one, I think that in the last couple of years, the wirehouses, Morgan, Merrill, UBS, has really largely stepped aside from recruiting. And what they've said is,
They stopped writing checks the way
well,
they were.
less so. We're going to do
Less
it
so.
more selectively. They've done it more quietly and under the radar. We're going to focus more on retention and preventing attrition. They've worked hard to do so. Their efforts at preventing attrition has largely backfired because the more they've attempted to tie these folks up, the more they want out. It's like telling a child.
They're all,
you
by the
can't-
way, they're all shrinking, but most of them say, like James Gorman is like, no, we want to be smaller headcount. We want. I mean, is that spin or?
I think that we want to be smaller headcount is probably not untrue. They'd like to be smaller, but
Higher
have
quality,
bigger, better
but less
advisor.
people.
Exactly.
I mean, that makes
and there's
sense to
nothing,
me.
and that makes sense too. Nothing wrong
Yeah.
with that. But I do think that you can't not recruit if you're a firm that big. If you've got attrition, whether it be natural or otherwise,
Yeah, you're gonna have age-based attrition either way.
And attrition because you're pissing people off. So I think that you have to be recruiting. So I think that for the last year or two, the biggest deals and the biggest names we've seen in recruiting, the recruiting powerhouses have been the names outside of the wirehouses, RBC, First Republic, Rockefeller, and many others like it.
And are they all just sitting outside Wells Fargo? Like, come on, we got you? Or is it not quite that severe?
Well, Well, no, it's not. I mean, believe it or not, there are many large teams going to. We have several very significant, very high quality teams moving to Wells Fargo in the next quarter or two. And it's not just because they're being paid a big deal. In fact, they were offered bigger deals elsewhere. But they're people that really like the combination. They like the non-New York-based wirehouse. They like the culture.
Right. It's a
they
big
like
bank,
the
but it's
and
Californian.
brokerage.
And,
totally.
right.
And there are many things about it that are very appealing. So I would not count Wells Fargo out.
Okay. Well, listen, we really appreciate you coming by and letting us know what's happening. I feel like you're one of the most plugged in people on this topic. Will you come back?
My pleasure.
Love
I'd love
to have you come back.
Thank you.
Okay. Where do you want people to follow you? Or I know you have the podcast. So that's, what is it called?
Mindy Diamond on Independence. It's a podcast that we do.
But it's like iTunes, it's Spotify.
On
it's
every platform where you can find
Mindy Diamond
podcasts.
on Independence. You have to start listening to that, especially if you're in the industry. She's giving you the goods every 2 weeks on what's going on. And then what's your website?
Diamond-consultants with an S at the end.com.
We'll link
Thank
to that
you.
in the bottom. Let us know what you think about the recruiting market for financial advisors. We love your feedback. Go ahead and subscribe to the channel if you have not already. Follow Mindy Diamond, and we will be back with you soon.